welcome to the first LaingBuisson webinar in this COVID-19 world. My name is Henry Elphick, I'm the CEO, and I'm delighted today to be launching our UK childcare market report. I'm going to start by thanking our partners, Cairneagle, who have written the report and who are experts in the education sector, Nursery World, who are our media partners, and Gowling WLG and Care Markets. The report itself is available online and also via any of your LaingBuisson account managers. And it really looks at not just the market itself, but also the politics and regulation, the payers, staffing, providers, investors in the sector, and the market potential, the market outlook. So I just want to set the scene by defining the market. How do we look at the market? We're basically calling this the private, voluntary and independent group market, the PVI market. So those are people registered with the regulator with Ofsted, providing full daycare services, open all year round, and accepting children between the ages of 0 and 4. This year, we're also including school-based nursery classes and maintained nursery schools. So these are local authority funded. And that's a change in the definition from previous reports. And therefore, it's important to understand that when looking at the market size in this the 16th edition compared to the 15th edition and previous reports. We've also excluded from the scope any facilities or people who don't provide full daycare, but only provide sessional daycare, or provide daycare from domestic premises. So this is very much looking at the professional market. So COVID-19 is not something one could ignore. At the moment, key workers' children are still being schooled, but I think there is some confusion out there as to exactly who qualifies as a key worker. And even if they are a key worker, not all of them are actually taking their children into nursery. Many of them are choosing to keep them at home and to isolate. But one thing we can say as we look at COVID-19, if there are any lessons from the 2008-2009 recession, it is that the nursery market is incredibly resilient. The nursery market managed modest growth during that period when GDP shrank by 6% and consumer spending shrank by 5%. And that's very similar to some of the forecasts that we're looking at as a result of COVID-19. The one caveat is that COVID-19 is obviously a supply side, not a demand side shock, and the dynamics may therefore be different. But the government is clearly looking to bridge the next 3 months by keeping as many people employed as possible. And clearly these services are absolutely critical to any functioning economy. From an investor perspective, LaingBuisson like this sector because it still remains incredibly fragmented. If you look at the top 4 providers, they still only have 7.5% market share. If you think the Competition and Market Authority's trigger is around 25%, there's a significant runway of consolidation. And I think we look at this as very much like the elderly care market in the 1990s. There is a long, long runway of further consolidation. Today, we have 2 larger providers, Busy Bees and Bright Horizons, with 3.6 and 2.9% market share. And then there's a real drop to the next layer. So look, I think this is a really interesting market. Arun is an absolute expert in this sector. And what I'm going to do now is hand over to Arun to take us through a short presentation which gives the highlights of the report and hopefully gives you food for thought to either ask him for more analysis or to buy the report itself. So thank you very much.
Thank you very much, Henry. Well, just by quick introduction, I'm Arun. I'm a partner at Cairneagle. We're a global independent strategy consulting firm focused on the education space. And we have a particular passion for childcare. We've been involved in many of the UK and European transactions over the past few years. And in addition to that, we offer strategic support and post-merger integration support. We've had the privilege of working with Henry and the team at LaingBuisson this year to produce the 16th edition of the Childcare Market Report. And in this webinar, we're really going to aim to cover a few key areas which we touch on in the report. those are really just to give a sense of the market size, the structure, the key trends, to give to really talk a little bit about the investment thesis, and then the outlook for the future. So just to provide a bit of background in terms of timeframes, we undertook writing of this report and over the course of the second half of 2019 and into early 2020. And the type of work that we did was, it was a real combination of a significant amount of original research and analysis, building on some of the work from the previous editions, interviews with key operators and influencers, and 2 surveys. And those 2 surveys were, one, a survey with single site operators run by LaingBuisson and Cairneagle, and secondly, a survey of group CEOs. We got about 60 responses. That was a joint Cairneagle and NMT survey. And that gave a sense of direction and priorities. We do appreciate that this work was undertaken really before the current coronavirus crisis took hold. And I'm not going to try to opine on the impact of coronavirus. Henry's already said a few words, and things are only moving very quickly anyway. The world that we're living in as of today on the 23rd of March already looks very different, one from just 7 days ago. But I mean, I think it's worth saying that whilst we do see an impact in the short term from the coronavirus, we do expect our view of trends to be correct once we got through these challenging times and normality has resumed. So just really starting, the first thing we'd like to do is to focus on an overview of the market size. And our view is the market size was over £6.5 billion in 2019. Overall, about 65% of children age 0 to 4 use some form of formal childcare. And of that, our estimate is that about 600,000, just over 600,000 FTEs use full daycare nurseries, which is the subject of this report, which compromises around about 1.2 million children. Just quickly say the difference between FTEs and a number of children being that this is a market, a unique market in some ways in the education space, that you do have quite a lot of part-time enrollment, which you don't have in schools or further education or higher education in quite the same way. London and the South East are the largest markets in the UK, and that's really by dint of 2 things: A, the populations, and B, the pricing and the premium pricing that they can charge in those areas. The other important thing to say about this market is it is predominantly a private market. In fact, around 80% of the market by value is private, and that's very different to, say, the school space, which is only about 7%. Now, just a bit more in terms of overview. This is a highly regulated sector. Each of the countries of the UK has its own body which regulates and inspects nurseries. But the reality is, within the UK, that England constitutes the majority of population, and therefore the majority of nurseries are regulated and governed by Ofsted and the EYFS, Early Years Foundation Stage Framework. And that helps to create a level of homogeneity in terms of how children are cared for and educated, although we still believe there is plenty of room for differentiation and winning within that market. And funding is quite a complex one. It's ultimately a service for parents, but they only pay for a part of this service. Most importantly, there is government funding for what is called free entitlement or funded hours, which are 15 hours for the 40% most deprived 2-year-olds, and then either 15 or 30 hours of care for 3+-year-olds, depending on parent circumstances, but an absolute minimum of 15 hours of guaranteed funded hours, or free entitlement as they're called. There's also other funding, so that will include funding for parents in the form of tax credits, tax-free childcare, the government providing VAT exemption and facility subsidies and apprenticeship subsidies. Also, there are a small cohort of corporate nurseries much, much smaller than in other countries such as France or the USA. So in terms of how the market has performed, this is a market that has seen a period of sustained growth. FTEs have increased by just almost 3% year on year since 2010. And market value has been increasing steadily since 2008. Fee growth has really offset any of the declines in enrollment that we're seeing post-recession, really from 2008 to 2012. And that speaks a lot to the resilience of this sector and the investability of it. Now, that said, we do think we are entering a period in terms of slowdown of growth. We've undertaken a detailed assessment of the drivers that really impact the market. And they are, as you can see on the side, overall, slightly less positive than they have been historically. And that means that we don't quite expect the same levels of growth in the market as we have seen in the last few years. But it is worth saying that we do believe that the net position for the market is still positive and it is still one of growth. Not least of all because there is increasing maternal workforce participation. That view of a slightly tougher market is resonated by the survey that we undertook with group CEOs. If you look on the left-hand side here, you see that when we asked them the question last year, we undertook a similar survey in 2019, how they saw enrollment for the previous 3 years. Every single person we spoke to said that they had seen growth in the market. When we asked them at the beginning of this year how they saw last year pan out, more than a third stated they either had a flat market or a declining one. And it's worth saying that even those operators who experienced more than 10% growth didn't really experience it on an organic like-for-like basis. A lot of that growth was really a result of new builds and the maturity of those. Interestingly, there's a lot of positivity about the outlook for 2020 compared to 2019, but it is worth saying that that view of 2020 was expressed before the coronavirus pandemic, and it's already having an enormous impact on the nursery sector. I've been on the phone to a number of operators even this morning talking about the reduced enrollment levels, down to 5 or 10% of what they normally have today. The good news is that this is the first time we're seeing the sector club together. A group of leading operators is coming together in a more formalized format to share experiences and understanding, to collaborate on solutions, and to really feed into lobbying. So we are hopeful that the sector will work together to come through this crisis and come out the other side stronger and more connected. Now, I'd like to quickly move on to the second area which we wanted to cover, and that's really about the investment thesis. And we believe that this is one of the best sectors to invest in within the education space, and there are a number of reasons for that. We've already talked about some of the strong fundamentals for growth, socioeconomic, maternal workforce participation, affordability because of funding, and the high level of recessionary resilience, for normal economic downturns. And yet it's possible that the COVID crisis might not be a normal economic downturn. I think very importantly, this is a very fragmented market, which speaks to a strong buy and build strategy, one that's been going on for a number of years already, but has a lot of runway, which we'll go into in a second. I think as important as those is really the ability of commercial, sophisticated operators to impact commercial decision-making, to put in economies of scale and to really outperform the market. There are a number of other reasons which contribute to the strength of the sector: social response, the fact that it's socially responsible, the ability to raise funds, the ability to internationalize. But what we'll focus on today is just a couple of these. So really just speaking to the fragmentation of the sector, it's really a combination of small private and voluntary sector settings alongside corporates, regionals and local groups. According to our analysis, we see that 56% of settings today, which is the second column here, are run by single site operators. That's even more fragmented than vets and dentist surgeries and funeral care. And we expect a similar consolidation over time. Secondly, I just really wanted to talk about the position which large group operators are in. Before we do that, I thought it'd be worth talking about some of the challenges that the sector faces. So we've undertaken a survey of operators both this year and last year, and consistently we see staffing as the most key issue, both in terms of recruitment and retention, and in terms of the wages that the staff wages, especially in relation to the fact that there are national living wage increases which are well above inflation. Just to mention one or two others, the funding rates have for a long time for free entitlement funding been deemed on an evidence-based basis to be well below the cost of delivery, and that's been a challenge and significantly increased. And there's been increasing competition from schools getting into the delivery of 30 hours in funded places. But we believe from this that actually to win, you only need to gain a small part of the market within your very local catchment. And we believe this brings us to our view that it's really never been a more favorable time for a group operator to outperform and to take advantage. So just to talk to a few of these, procurement not only can provide economies of scale in terms of cost, it can mean buying better on a quality basis. In terms of having a central function, you can both have overhead synergies, but you can also start to create specializations, which means that people do what they do best, both at the head office level and at the nursery level, and you just get a better functioning machine, for want of a better term. The fact that you have a large group means that you can really invest in quality, navigate the regulatory environment to achieve good outcomes for children in inspections, and to have a sensible and commercial and sustainable approach to the funding challenges. As part of the survey that we undertook, we asked large operators how they were doing with 30 hours, and the vast majority, more than 90%, said that 30 hours had been a successful implementation for them. And that's a stark contrast to the rest of the sector, when you often hear that it's doom and gloom. And that speaks to the fact that they are making sensible commercial decisions to make it work for them around wraparound, around additional charges, around limiting the number of hours, around stretch, and so on and so forth. Large operators can have balance sheets and can have cash flow positions which protect them. And that's never been more important than in today's crisis, where hopefully the balance sheets and the cash flow position of these large operators will help them to weather the storm of the COVID crisis. Large operators can invest in a differentiated offering, and we see a lot of that, really specialist offerings to make sure that they can outperform the market in sales and marketing. And again, we see those operators really think quite carefully. We've only started to hear the word CRM used in the last 12 months, really, around intelligent pricing, and also in terms of how they're going to deal with their staffing, both in terms of recruitment and retention strategies, and clusters to be able to have bank staff pools. So that investment thesis has really brought a lot of people into the sector. On this chart, we just show a few of the major transactions that have happened over the last 3 years. The left-hand side showing some of the key consolidators and what they've acquired, and the right-hand side showing a whole bunch of other consolidators. From our tracking of the market, and I've had over 12 years experience in the market, I've never seen such an active market. It's incredible. And it just shows that, that belief in the investment thesis, but also the ability to be able to get arbitrage on the way out, buy in at a certain price and a certain multiple, and to exit at a higher multiple based on group premium. However, I think it's really important to be aware of pricing. What we've seen is pricing for both small acquisitions and large acquisitions increase over time. And what really happened in 16 and 17 was really interesting. There were two major transactions which were purported to have traded at not only double-digit multiples, but we're talking about 13, 14, 15 times, depending on what you believe. And what that really resulted in was that the smaller transactions felt that they could stretch their pricing, both from a buy-side perspective and from a seller expectation perspective, because they would have a lot of arbitrage when they sold, because larger groups are now selling at a larger price. The reality was that those two acquisitions had specific, unique circumstances. And those included the ability to make head office synergies in terms of the ability to capitalize on true pro forma or true run rate on ground rent transactions, and also specific circumstances for those businesses in terms of what their next investment moves were. For example, one of those was looking for a minority investment, which happened at the end of that year. And so they were able to pay more. And I think that created a false illusion. And that false illusion really came true last year, where there were 4 major transactions which came to market, which we looked at all of on the buy side, and all of which failed. And you know, the underpinning of all of those was a seller expectation which couldn't be met, amongst other things. And our belief is what's really going to happen as a result of that is that pricing for large acquisitions will come back to still growing against the historic trend, but certainly not at the same blip of 16 and 17. And that will eventually push pricing down for the smaller transactions, so you continue to have that arbitrage. And we're starting to see that. We've spoken to a number of operators and to corporate finance advisors who are starting to see that reduction. One banker mentioned that they're starting to see transactions more close to high single digits or low double digits on current EBITDA. And one operator said they are now able to buy single groups at the same type of price as single sites, small groups. We do think that there will be some craziness still in the market because there's a whole array of operators. You know, a lot of family money, a lot of private money, which means that small groups, single sites will still trade at very high levels, but not in aggregate at the same high levels as historically. So just really looking to the future, we've asked many operators what they see as the future, and almost two-thirds of those are still looking to expand. And other than being a function of stakeholder positions, for example, private equity owned and therefore needing to grow, it's a function of continued confidence in this market. And you know, and the fact that an unprecedented numbers are still looking to invest in this market. That might change due to coronavirus. It might just create delay in terms of kind of what the expansion priority is versus keeping afloat today. But if we talk about what those expansion priorities are, it's a real mix of new site openings and acquisitions and capacity expansions and internationalization. I just wanted to touch on 2 of those. The first is new site openings. It's really interesting to us that of the operators who are looking to expand, over 70% of those are looking at new site openings and more than acquisitions. And I think this is the first time we've seen an appetite for new site openings be higher than for acquisitions. And that's really a function of the pricing in the market and of the fact that with new site openings, you can really target where you want to be. The downside, obviously, to new site openings are it is much higher risk as well as high reward because there's no proven occupancy or sales or profitability performance. And the other one I really wanted to quickly touch on was internationalization. Yeah, I think it's worth remembering that the UK, which is the focus of the report in this webinar, is only less than 1% of the global population. And there are lots of countries which can really benefit from the depth and the maturity and thought of the UK system. And so we are starting to see operators to take advantage of that. Just really want to say thank you for listening. This was really intended to be a short introduction with more detail and insight in the report itself. I just want to say a quick thank you to the contributors to the report, and to say that we'd be happy to support anyone as they explore or maneuver through this very exciting sector. Thank you, and I'd like to pass back to Henry.
Arun, thank you very much indeed for that. A very comprehensive overview of the market. I think it's a very exciting market, and COVID-19 is clearly a threat today. But the reality is that childcare is going to be needed in the future. It's been a very resilient market in recessions in the past, and I have no doubt that it will be a very successful market for investors in the future. If you'd like to buy a copy, it's available online at LaingBuisson.com in our shop, or through any of our account managers who will be very happy to help you. Thank you very much. We plan to follow up with a more extended webinar on the topic of childcare in due course, and I look forward to speaking to you all then.